Hey, what's up, everybody? Welcome back to Investing Sucks. And today we're going to be taking a look at SoFi. So, this is another company that is quite popular in the retail investing community that has had a pretty spectacular turnaround so far in 2023. As we can see here, so far it's up close to 100% on the year. And you guys know that I really enjoy looking at companies in the financial services space just because I think it's a very misunderstood and often overlooked area, and there's just so much nuance to every company that's in this sector that you can really learn a lot about the economy as a whole by understanding these companies like banks, insurance companies, fintech companies, etc. So that's what we're going to be doing today is to try and understand SoFi on a fundamental level and not just, give a surface level look where, we're just looking at what they did last quarter or last year or something like that. But how can we actually understand this company on a deep level to know whether or not it's undervalued? Is it overvalued? Are people being too optimistic or too pessimistic about this company? And things like that. So, without further ado, let's actually dive in. Now, real quick before we get started, if you're wondering what this website is that I'm using here, this is Tickernomics.com. This is a website that I created that is designed to just provide retail investors with a lot of financial information about companies. And it's currently in the beta stage where we're getting feedback from users on how to make this website better. So if you are interested in doing that, I'll leave a link in the description of this video to use the website. You can sign up for free and make an account and give it a try. Look at all the features that we have available for it. And I'm going to be showcasing some of the functionality throughout this video anyways, so stay tuned for that. So the first thing that I want to do is I want to give a quick overview of a few key things you should know about this company because this is really going to drive a lot of the conversation that we have in this video. So the business has three main segments. There is the lending segment, which offers personal loans, student loans, and home loans. There is the technology platform segment, which was developed over the past 3 years or so through two acquisitions the company made in companies called Galileo and Technisys. And then there is the financial services segment, which offers a whole suite of financial services. You can see SoFi Money, SoFi Invest, and then SoFi Credit Card here as well, which is likely the biggest moneymaker of this segment because they offer these credit card loans and they earn interest income on those loans, which, as we'll see with SoFi and pretty much any bank that you look at, interest income is going to be the biggest moneymaker for a bank. Although they do get referral fees and brokerage fees that contribute to this segment as well. And the lending segment is by far the largest segment. So they've broken out each segment in this section here where they calculate the contribution profit for each segment. So this is just designed to give us an idea of relatively how big each segment is and how much each segment is contributing to the overall profitability of SoFi, which they're not profitable yet, but I believe management said by next quarter they're expecting to be profitable and then going forward after that. So the lending segment is by far the most profitable segment. We can see close to 200 million in contribution profit here, 17 million for technology platform, and then financial services is still currently running a loss. But the lending segment is where the interest income is being generated, which, as I said, for any bank out there is going to be the key part of their revenue stream. So, regarding that whole banking aspect, a huge development in SoFi's company history happened in January of 2022 when they secured a national bank charter. And they did this via acquisition of another bank called Golden Pacific. And basically, what they did is they proposed this transaction. They said, we want to acquire this bank, which would then give us the national banking charter. And the bank regulator of the US then had to approve it before it could become official, which they did, and then SoFi Technologies became SoFi Bank. So why is this significant, right? Why is securing this bank charter significant for SoFi? Well, it's big for a laundry list of reasons. There's plenty of things that this enables them to do, but there's one main reason that I want to talk about that directly has a huge impact on their financial results, and that is it enables them to offer deposit accounts. And if we look at this chart here, this just maps the deposit growth that SoFi Money has seen ever since Q1 of 2022, which is when they were able to start offering deposit accounts. And we can see the different types. There's savings, demand deposits, time deposits, and also non-interest bearing ones. And it's growing at an extremely fast clip. As of their most recent quarter, they're at almost 13 billion in deposits, and they're adding about 2 billion new deposits pretty much every quarter, they said. So that's one of the reasons. And The key thing with deposits is that, for one, it allows them to fund their operations a bit more smoothly. And also, as a bank, the key thing that you're looking at is the difference between interest income and interest expense, right? What is the key, what are the key things that's driving interest income? What are the key things driving interest expense? And if you look at their interest expenses here, so this shows for the 3 months ended June 30th, the actual cost of each source of funding, which is going to be here, all these liabilities. So this line here, it shows us what the cost is. And these items here, the demand deposits, savings deposits, time deposits, this is what securing that banking charter enabled them to start gathering. So it shows the cost here, 2.5%, 4%, about 5% here. Most of these are cheaper than these other sources, right? We can see these warehouse facilities, which have gotten a lot more expensive as interest rates have gone up, securitization debt here, and then this general term here, other debt. But their largest source of funding is the savings deposits here, which has a cost of 4.02, which is less than the second largest one, which would be warehouse facilities at 6%. Now, this has increased quite a lot since if we compare it to the quarter previously. And this is just because interest rates have gone up, but also this is kind of the reason why they've been able to grow their deposits so fast. If we go back to this section here where we're seeing how fast it's growing, it raises some questions, right? Because wouldn't all banks like to have deposit growth this fast? And, over the past year and a half, arguably we're in a recession, money is tight for a lot of people. How is SoFi able to achieve this with all that going on? And aren't there other banks out there that are competing for these deposits? Well, it's no secret what they're doing. They're just offering very high rates on savings accounts to lure in people from other banks to put their money at SoFi. And the idea is that's going to help with customer acquisition and customer retention, right? Because, in a way, they can spend all this money on marketing and, making their products better by looking at R&D and that kind of stuff. But if they just directly offer high rates on their accounts, on their savings accounts, that's just going to initially attract people right in because people want to save money. They want to see their savings grow. So in a way, they're paying for customer acquisition by doing this. Now, they're not doing it irresponsibly. That's the key thing because as I'll talk about this a lot more later, but they're not, putting themselves in any type of financial harm by doing this. So I'll touch more on that later, but for now, the key point here is what that national bank charter enabled them to do, which is cheaper funding and also a source of funding that they didn't have access to before. So ever since SoFi officially obtained this bank charter and they became a bank, there's been this ongoing debate with them where some people argue that SoFi is now just another bank, right? There's nothing unique about them. They're no longer a tech company, and you should evaluate SoFi as you would evaluate any other bank that's out there. And then there's other people that say, no, they're not just a bank. They are still a tech company or a fintech company, and you can't evaluate them the same as you would with a normal bank. They do have banking-like revenue streams, but they are fundamentally different than other banks that are out there. And I think both these arguments have a little bit of truth in their own rights. And I do think that this is a important debate to settle because how a company is viewed by the general public, right? Is it a bank or is it a fintech company still? That view influences the company's valuation. And as an investor, you need to understand how a company is viewed by the investing public in general to understand why it's valued the way that it is and whether or not you actually agree with that. For example, if we do classify SoFi as a tech company, then a lot of the things that we see when we look at their income statement make sense, which I'll zoom in a bit here. We can see the very fast revenue growth, right? The growth in interest income here almost tripled from Q2 22 to Q2 23. And then if we look at their expense items, they're spending a lot on sales and marketing, which is typical of fast-growing technology companies because they're trying to get word out there. They're trying to acquire new customers as quick as they can. They're spending a lot on technology and product development. Again, they have to develop these products and make sure that they're the best on the market. These are characteristics that are very common with technology companies or fintech companies. But if we decide that SoFi is actually a bank, they're a very unusual bank because banks usually don't have this much of their expenses going towards product development and sales and marketing. So we have to decide, are we comfortable with that? And we also have to consider this very fast revenue growth because if we classify SoFi as a bank, then seeing revenue growth this fast may actually be cause for concern because what it can indicate is they're extending credit to too many lenders, thus enabling them to grow their interest income this fast. And maybe they're extending credit to certain lenders that aren't deserving of that credit. That's going to spell trouble later on if something bad in the economy happens and they can no longer collect on those loans. So maybe they're giving money to people that are a bit more risky than SoFi investors would like them to be doing. Personally, I don't think that's the case. I mean, obviously, I don't know that for sure, but based on what I can tell from looking at their financials, I don't think that's the case. And I'm going to show you why specifically I think that later. But back to the debate about whether they are a bank or are they a fintech company. To answer this, the best way to do it is to just look at their revenue streams, right? Don't look at, what they say about the company and, what's in all their marketing materials. For example, one thing they talk about is this thing called a financial services productivity loop. They detail it here. And the idea is, create this virtuous cycle where you have positive member experiences that leads to new product adoption. And thus, you're basically upselling your customers by using things like technology and all that. That's nothing unique to SoFi, right? Every bank is trying to do that. Now, SoFi may be better at doing that than other banks out there, right? They may be better at leveraging data to get insights on their customers and to offer them new products and services that they're going to find valuable. They're better at upselling them, but this isn't some unique advantage that they have. So let's ignore, all the fluff that's out there and just look at the company for what it is, which is, their actual financial results. So if we look at their income statement here, how are they earning their money? They're earning their money like a bank earns their money, right? Interest income through loans, which is their largest money maker, right? That's how they're paying for all this, fancy technology related stuff, like all the data and analytics that they're doing on their customers is through, interest income on their loans. And then they have to pay interest expense on the deposits, which they're now able to, attract deposits. And then non-interest income, plenty of banks have non-interest income, which they earn through loan originations and sales. So they're still, securitizing some of the loans that they generate, which that's still a big activity for them. There's some servicing rights that they earn some income on here as well, but they do have this extra line item in their income statement here, technology products and solutions. So not all banks are going to have that, right? This is unique with SoFi, is they have this one additional revenue stream. And personally, the way I would, evaluate SoFi knowing this is that they are a bank, but they have this one extra revenue stream that is technology related. And later on, when we do the valuation, the way that I've basically done it is I take this, technology segment, I break it out from the rest of the bank type of business. I do a discounted cash flow of the technology segment to see how much is that segment worth, how much value does that add to the business overall, and then evaluate the rest of SoFi like just a normal bank, where we just look at earnings, project earnings and EPS out into the future. We take a multiple of that, then we get an idea of what their stock price will be going into the future. So I'll show you that analysis later. But that's basically how I would think it. They are a bank that has one additional revenue stream that is technology related. And maybe they are better at leveraging the technology within the bank to, retain customers, attract new customers. That's all possible, but that doesn't make them a tech company, right? Because if that did make them a tech company, you could argue a company like Crocs is a tech company because of the technology that they use to make their Crocs is, proprietary and no other company has it, and it gives them this competitive advantage, right? I mean, sure, like that's probably true, but that doesn't make them a tech company, right? So we have to look at the actual substance of the business to understand that. Now, one thing I was also curious about, and I created this script here in my website, again called Tickernomics.com. And if you are curious to look at some other scripts that we've created, which these all perform unique analytical tasks by, synthesizing, analyzing financial information. We have a list of public scripts here, which are available to anyone who wants to use the website, such as the Magic Formula one that calculates owners' earnings, Warren Buffett's metric, one that finds net stocks. There's a whole bunch here, so feel free to explore that. But I created this new one, which is called Fintech Stocks Key Metrics. And I'm looking at a few key metrics of similar companies to SoFi. So I have a list of them here. And the ones we're looking at is number one, I'll sort by this here, which is research and development as a percentage of the company's revenue, right? So SoFi, 20% of their revenue, they're spending on research and development. Now, not a lot of companies. They're going to see a lot of zeros here, and this is partly because not all companies will have this item on their income statement, but also because they may call their research and development something else, right? It's when you're getting, to a very granular level of detail, looking at expense line items, all companies call it something different. There's a few companies here that have called it what SoFi has called it, which is, basically just research and development. They spend 20%. A comparable company, a fintech company, NerdWallet, spends 10%. Upstart Holdings spends 42%. So, they're not the highest. It's not outrageous for what they're doing. But in terms of banks, it is kind of unusual. Now, there's also this one, which is SGA, Selling General Administrative, as a percentage of their net income, which here's SoFi down here at 21%. And there are quite a few companies that are above that. So SoFi isn't standing out in the amount that they're spending on specifically this. Now, there's also marketing expense, right? Are they spending a ton on marketing? They're spending about 10% on marketing. So it is a lot, it's up there. It's not as high as NerdWallet here, which is 22%, but it's significantly higher than a lot of these other corporations we're looking at here, Upstart, Open Lending, Consumer Portfolio, and things like that. So compared to other companies, certain categories it seems like they're spending a lot, and certain categories there aren't. So SoFi is a very, very unique bank in that regard. And then also we can look at year over year revenue growth. So where's SoFi in this? They're actually pretty near the top at 50%. There's only one company in the industries that I've filtered for here that is higher than them. Most companies are growing revenue a bit slower than them. So I thought this was interesting just to get an idea of, how does SoFi stack up in their spending to other comparable companies, right? And again, I think the main takeaway here is when we do a valuation of SoFi, we have to split them out into the two separate parts, which I will show you when we get to the valuation. Okay, so we've talked a lot about the income statement side of SoFi now. Now I want to dive into the balance sheet side. So looking at things like their capital, liquidity, what types of loans are on their loan book, and things like that. So when we take a look at their balance sheet here, we can see that the largest item on their balance sheet is this one, loans held for sale at fair value at $18.2 billion dollars out of the 25.5 in total assets. They also have $3 billion in cash, which is quite high, right? And that does give you quite a lot of comfort as an investor in SoFi because it means they're highly, highly liquid. They have plenty of cash, and if they have to take on a little bit of losses, then it shouldn't be an issue for them. And then we scroll down to the liability side. What's their largest liability? Well, it's these deposits that they've been accumulating so fast. So, and then also this line here about 6.4 billion in they've just called generally debt. That's another way that they've been funding their business, but now they're primarily doing it through these deposits. So they're taking in these deposits, that's their largest source of funding. They're using it towards their largest asset, which is these loans, right? Some of the loans they hold in their balance sheet to earn that interest income, which they are doing more of that now as they, decide whether to securitize and sell off or to hold the loans on the balance sheet. But that's is still, they're securitizing a lot of these loans. And I want to take a look at that whole activity a bit more. So we go to this part here of their filings, and it talks about their securitizations. So what they do is they originate these loans. Sometimes they hold them on the balance sheet. Maybe they hold them on the balance sheet for a little bit and then eventually sell them. But it carries a little bit of risk because there is a chance that these loans could go sour and they might not be able to find a buyer. And they do originate very specific types of loans. As we can see here, they originate personal loans, which exposes them to general economic risks like unemployment rates and debt servicing costs of households in the US. And the fact that they are generating primarily personal loans, that's been their largest source of loan originations. And that's primarily because interest rates have gone up so much that people are taking on these personal loans to consolidate and refinance a lot of their debt in light of these interest rate rises. So it's helped their personal loans, but their other forms of loans, which is student loans and home loans, it's actually hurt them in a little bit. And home loans, it does expose them to real estate risks. And then student loans, which student loans is really how they made their name in the first place. That's primarily what they were doing in the early days of SoFi. And student loans are a hot topic right now. For example, they have a whole section where they're talking about their student loans. And if we go down here, there's a section here, student loan relief. So essentially, what happened was in 2020, Joe Biden passed the CARES Act, which put a freeze on student loan repayments. But then only a few months ago, this got lifted. So now student loans need to be paid. And because of that, SoFi may start to see more originations because originations have been pretty weak for this because people haven't been required to pay back their student loans. But now that they do have to do that, maybe some people want to extend the term of their student loans, even if it means taking on a higher interest rate. If they need to lower that monthly or annual payment, whatever it is, then they might look to SoFi to refinance that. So that could help them a little bit. But the fact that interest rates are still so high means in the home loans and in the student loans, it's probably going to be a slightly weak demand, but the growth in the personal loans department has been very, very strong. So this is all very uncertain, right? There's so many different things that go into this. Another thing that I want to discuss is their credit card portfolio, right? So does present a key risk for SoFi because they don't securitize their credit card portfolio, and they have seen, as we can see here, a massive uptick in charge-offs as I've just taken note of what the charge-off in the credit card portfolio has been over the past few quarters. It's gone from 4.3% to almost 20%. So almost one in five of every dollar that they lend as part of their credit card, they don't actually end up collecting it. Which strikes you, as that's extremely high, right? Is that going to spell trouble for SoFi? Are we going to see another Silicon Valley bank like collapse because of that? Well, not really, because the credit cards are a very small portion of their overall loan portfolio. And this metric here is the total charge-offs, right? So this includes the credit card charge-offs and then also charge-offs related to all the other types of loans they have, which again is the personal loans, home loans, student loans as well. So that's only at 2.33%. It has gone up pretty substantially. It's gone up from 0.6 to 2.33% here over the past few quarters. But why this isn't really an issue is if we scroll down here, they're making up for it with a high net interest margin. And the net interest margin has gone up pretty substantially. It's been boosted a bit by, them obtaining this banking charter, and now they can um, take deposits, which is a cheaper source of funding, but they've also just increased the rate that they're earning specifically on their personal loans. Again, pretty much in line with the interest rate increases. So I was curious, because banks in general, right, they're performing this risk balancing act, and that's kind of what this analysis here, this benchmarking I've done with SoFi, Lending Club, Equitable, which JP Morgan, and then Citizens Financial Group, which may seem like a random assortment of banks, but I wanted to take different types of banks that are out there, compare them to SoFi on these two key metrics, the net interest margin and the loan charge-offs, to see, are they an outlier compared to these other ones? Because you may have, an uptick in charge-offs, but you can justify that if you're earning a higher net interest income. Because if you are earning higher net interest income, it means you're probably loaning to more risky lenders, right? That's why you can charge them a higher interest rate because they're more risky. But what you're going to get penalized for is more of those loans aren't going to end up getting collected, right? So that's the risk balancing act that banks do. And I basically calculated this, which is a ratio. So it's net interest margin divided by charge-offs to see where SoFi stands compared to the other ones. And they're kind of just in the middle of the pack, right? Which is what is good to see because it means they're not some outlier where they're taking on a whole bunch of risk and not getting compensated for it, or their net interest margin is super low and they're having a disproportionately large amount of charge-offs for it being that low. Lending Club was really the outlier here because their net interest margin is 7.1. Their loan charge-offs as of the most recent quarter was 4.4. I also included EQB, which is a company I have a lot of my own money in. This company I've talked about a lot. Um, they stand out as an outlier too for the good reason, which is their net interest margin is low, but their charge-offs are also extremely low as well. And then I included, a large bank conglomerate like JP Morgan to see how they stacked up to that. And, pretty similar overall. And then Citizens Financial Group, which is it's a regional bank, but it's kind of a large regional bank and pretty comparable to SoFi in this regard. So this did give me some comfort that SoFi's risk management, as it stands now, is showing some good signs. It seems like they know what they're doing, and they're not taking on these huge losses and not being compensated for it. Now, another thing I wanted to point out regarding SoFi's funding and just, their ability to not have a blow up event like what we saw happen with Silicon Valley Bank. So, if you recall what led to that collapse of Silicon Valley Bank, it's because they had invested a lot of their deposits into 10-year mortgage-backed securities. And when interest rates started to go up, these securities lost a lot of value. And when their depositors started to flee because their depositors were startups that were short on cash because they couldn't raise funding as easily. Once that happened, they were basically forced to sell these securities at a pretty sizable loss. So it was just poor risk management overall. So I was curious to see how does SoFi relate to that? Are they doing the same thing, which, would be a huge cause for concern, or are they doing okay? And the answer is they're doing okay. They don't actually have that much of their deposits that get invested. A lot of it really is just ends up going into these loans, which we talked about, which we just did a whole analysis on the risk of those loans and the charge-off rates for those and what losses on the loans will look like. In terms of the investment securities, this number right here is key. So it's about $6 million that they have in unrealized losses on their securities portfolio that they've invested in. Now, the problem with Silicon Valley Bank was this number for them, these unrealized losses on, available for sale or held to maturity securities, was basically eating up their entire equity, right? The loss was pretty much bigger than what the equity on their balance sheet was, which means, they basically don't have any capital, which for a bank is a huge deal. But this is only about $6 million. Let's look at the equity on their balance sheet and see what it is. So equity is about 5 billion. Yeah, 5.2 billion. So it's, 1.5, 1.4% is that unrealized loss of their total equity. So a very secure bank in that regard, and really there's no blow up risk that you would sense with SoFi, resulting in them, investing in securities that just lost a ton of value. Okay, so lastly, as promised, we're going to dive into a detailed valuation of SoFi stock. And like I said before, I've done this as a sum of its parts where I've broken out the technology platform segment, which is all of this here, and the lending and financial services segment, which is here. And I'm not going to go super in depth on all the nitty-gritty details. I will link this spreadsheet in the description of this video as a Google Sheets file if you guys want to take a look at everything that I did. But just know that the technology platform segment, I have assigned a value of about $775 million, which is the present value of it, which I just took the future cash flows that this is projected to generate to the year 2028, plus a terminal value, and then discounted all that to the present, which I got this value here. And then with lending and financial services, I have projected their growth rates going forward into the future years here, 2024, or I guess the second half of 2023, all the way to 2028. I am assuming they are still going to grow very, very fast, 50% growth, 35%, 25. The growth is going to taper off in the later years, but this is very strong revenue growth overall, especially for a bank, so this is a very growth dependent valuation, which SoFi is, right? And there's also the non-interest expense growth rates, which I'm projecting are going to grow, but they're going to grow at a rate slower than the revenue, right? Because as they achieve scale and they become increasingly profitable, as they're able to generate more interest expense and make better use of technology and just bring their costs down. I mean, that's what the company's promising they're going to do. So that's what I've projected them. And then we have their earnings here, which I divide their earnings by the amount of shares they'll have outstanding, which is going to continue to be diluted a little bit because they do have a share-based compensation plan for their employees, which is pretty generous. So there is going to be some dilution there you're going to have to deal with. But they'll have EPS of around 1.6 in the year 2028. So then we go down here, and there's a low scenario, which is a price to earnings multiple of 7, a mid scenario, which is 10, and then a high scenario, which is a price to earnings multiple of 12, which is all very reasonable for what you would expect with banks. And that's going to lead to different, future share price estimates. So we get $11 here, $15 here, $19 here. We do have to add the impact of the technology platform segment, which is another 83 cents per share, which I've calculated that just by this number that I calculated up here, divided by the amount of shares they have outstanding as of now, which is about 936 million. So we add all of that. Their current share price is about $8. And then we get our annualized return, which just adds this price estimate plus the technology segment, and then compares it to the current price. And then it's an average annual return over a 6-year holding period for each scenario. And we can see in the low one, we get about 7% per year. In the mid, we get 13%. In the high, we get 16%. So if you believe these mid and high scenarios, then the entry point right now for SoFi, it does make sense. But these are very optimistic assumptions. And just to be, crystal clear with this, these assumptions that I've put in here, these growth rate assumptions in revenue and expenses, this isn't my prediction into the future of what I think is going to happen. Like, I'm not making investing decisions myself based on these assumptions. I have put these in here because this is what needs to happen for SoFi to be a good investment at its current price. It is a very, very growth dependent valuation. They are expected by investors to grow into their current valuation going into the future years, which is actually kind of pretty interesting because one of the key metrics you can look at with banks is the price to book value ratio. Right, so I'll pull up SoFi here again because I want to show you this. This is actually pretty interesting. It can be a little misleading that SoFi may not have that high or that much of a growth dependent valuation if you look at it on a price to book value basis. For example, we pull up their price to book value ratio here. Where does it currently sit at? We can see here it's about 1.3. Let's pull up a large financial conglomerate like JP Morgan Chase. What's their price to book value ratio? Because we're comparing them, to a sizable or reputable bank. So we'll zoom in here. It's pretty comparable, right? JP Morgan's in the purple, SoFi's in the green here. It's pretty much exactly the same, actually. So it doesn't seem, and you'd assume a company like JP Morgan isn't going to be growing their revenue as fast as SoFi is. So it is a little misleading the fact that they have this objectively a very growth dependent valuation, but it doesn't really seem like that when you look at, very simple valuation metrics. But yeah, so overall, my thoughts on this company, I think it's important to understand where SoFi came from, right? They are a Silicon Valley based tech startup. So when these companies that come out of Silicon Valley are basically conditioned, their management is conditioned, they're programmed to try and convince you that they have some distinct competitive advantage, that there's something unique about them that no other company out there can replicate, and they're going to be super successful going in the future. That's what they're all aiming for, right? That's, the gold standard of business is a competitive advantage that no one else can replicate. But the reality is, and this goes for all types of companies, not just banks, is if a company is trying to convince you, they're constantly telling you, this is a unique advantage we have. This is our key competitive advantage. This is another advantage that we have over our competition. If they're constantly doing that, chances are they don't actually have one, right? They may think they have one because there's certain things that they're better at than others. They may be better at utilizing technology. They may be, better at deciding which lenders to extend credit to, all that kinds of stuff. But if they're constantly trying to convince you, then it means they probably don't have it. The companies that actually do have that are the ones that are getting slapped with antitrust lawsuits, right? And so there's a few companies that come to mind with that. And there's a lot going on right now in the world of antitrust. And I actually might make a video on that in the future with everything that's going on there because there's some very interesting stuff that's going on there. But yeah, those are just my thoughts in general. Like, I do think SoFi, as a bank, they are a very well funded, a very well capitalized bank. They're growing extremely fast. They do specialize in some very specific types of loans, which does expose them to certain risks, right? Like, personal loans has been a big money maker for them in recent quarters, which if, jobless claims start to go up, if employment starts to go up, or unemployment starts to go up and things like that, that's going to pose a huge risk for them. So the fact that they're concentrated in those specific areas of loans They're not a large diversified bank like JP Morgan. That does present a risk, but they are growing very fast. And, the risk level that they're taking on seems to be commensurate with what they're earning in terms of their actual interest income. But the catch for all of that, all the fast growth and everything is that it is a very growth dependent valuation. So you have to make the decision is if you agree with these assumptions that I have here and if you think SoFi is actually able to achieve those. But yeah, that pretty much does it for this video, guys. So I hope you did find this insightful. If you did, then please leave a like on this video. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.